after the decision, we saw a drop in rates on the short end of the curve. But notice this, we saw a modest, a very small, but still a increase of rates on the long end of the curve. So that's really interesting. Hello, everybody. It's John Llodra here. I'm a co-founder and partner here at New Harbor Financial Group, here for a timely take. It is Thursday, the 19th of September, 2024. Yesterday was a big day in the markets, actually economic news. It was the September monthly Federal Reserve Open Market Committee rate meeting where they decided on interest rates. This has been in the news for weeks now. It's a very anticipated meeting, which it was all but certain, actually very certain, that the Fed would start to drop rates after having peaked their rate increase campaign back in July of last year. So we've gone over a full year with rates, short-term rates that the Fed sets at a target range of 5.25 to 5.5. So yesterday's meeting was very, very anticipated and a lot of uncertainty going into the meeting. In fact, the big debate was not whether they were going to cut, but whether they were going to cut by 0.25 percentage point, 0.5 percentage point, or even, as some senators from Congress demanded, a full 0.75%. The decision came out yesterday, and it ended up being 0.5%. So, in fact, the market probabilities were roughly equivalent going into the meeting for a 25 or 50 basis point cut. So it was probably the most divided expectations going into a meeting that we've seen in recent times. But the news was a cut of 0.5%. So the question is, what do we read into that? Our opinion going into this was it wasn't so much important about 0.25 or 0.5%, but what the future path looks like and what the messaging about the future path might hold. So let's talk about the Fed is quite evidently shifted their major concern away from inflation and towards employment. I want to show you a chart here that was in Bloomberg yesterday, and it basically shows the number of Fed officials, Fed voting policy members, that consider unemployment as tilted risk, the risk that they should be most concerned about, or inflation. And so the blue line is inflation. So you can see over the last, certainly the last several months, the number of members that think inflation was a major concern or the most heightened concern has decreased. At the same time, the number of voting members thinking the job market unemployment rate is the more concerning factor has skyrocketed. So that's clearly what the Fed is concerned about. They messaged what you might say is a hawkish 50 basis point cut yesterday, which is a little bit of an oxymoron. Some people took the 50 basis point as, wow, this is bigger than expected. Fed came out and said, well, we're not doing this 50 basis point, 0.5%, as a sign of weakness. We think the job market, the economy is doing just, but we think that this is more of in their words, a recalibration to basically get ahead of potential further weakening in the stock market. If it sounds like wordsmithing and psychological messaging, that's exactly what it is. That's what the Fed uses probably more than anything, is their words and their impact on trying to create a psychological reaction. So that was a bit of an interesting play on words yesterday. Let's look at this next chart. This goes long term, and it shows a chart of both the unemployment rate in blue and the federal funds target rate in red. So a couple things I want you to note here is we have seen a turn up in the unemployment rate, and many officials, including the Fed themselves, have talked about how there likely will be further revisions in the data, that this perhaps is likely even understated. But if you look, the shaded areas here are recessions. And prior to every recession, we've seen turn up in unemployment and then a big jump during the recession, going back to virtually every recession on record. And then you can see in most cases, the cutting cycle, which is the red, you can see when the rates start to get cut, that oftentimes is just preceding a recession. So it's even though the Fed wants to talk confidence in the economy, actions and history speak louder than words in many cases. So it's a very interesting setup here that, in a historical sense, speaks to a heightened probability or heightened scenario of recession, even though they're still talking about soft landings and Goldilocks and whatnot. Where does the path of rates go ahead? This is a chart that was put together by this guy, Frederick Ducrozet. I found it on X Twitter yesterday. I think it's great because it basically shows, so the Fed has telegraphed that for the balance of this year, in the final two meetings, they expect to drop another 0.25 percentage point at each meeting. So by the end of the year, they will have dropped target rates a full percentage where they were set back July of 23. And then in 2025, they anticipate another full percentage point of drops. So 2 percentage points from the peak is what they're projecting by the end of next year. And that's evidenced here. So we would see, rates kind of plateauing under this scenario at about 3%, again, from, kind of just above the 5% target that was set last July. This shows index for the same starting point, what prior cutting cycles in recent times look like. So one thing I want you to note is, first of all, where we're starting at this time from a rate level is a lot lower than some of these instances in history. So for example, in 1984, we were above 10%. I think even above 10% in 1989 when the rate cuts started. So the fact that we're deeper cuts here just is more, I think, representative that we started at much higher rates than we are now. So the Fed doesn't have as much room to go. They can only go to zero, right? Theoretically, they can go negative, but that's not a shark that's been jumped yet. Anyway, so this is what the Fed has telegraphed for future rate paths. Virtually all these deeper cuts, 2007, 2001, and 2019, for example, were all in response to major issues. Big, tech bubble for 2001, housing bubble for 2007. 2019 was in response to the repo market blowing up in late 18. If we do see a deeper path here, I would say that this path is pretty much baking into the cake, that there probably will be some kind of recession. But if we see something deeper, it'd probably be something worse than that. So just something to keep in mention. What happened in markets after the Fed rate decision? So we saw, like most Fed days, we saw quite a whipsaw of actions. Most things, stocks, gold, commodities, bounced really hard shot higher really hard after the Fed decision. And then after the press conference, an hour or so later, sold off hard into the close. Here today, most of these things have shot up higher pre-market and are pulling off their highs in many cases. Interestingly, what didn't rally are longer term bonds. So many people think that the Fed, when they lower rates, it's automatically going to lower interest rates on longer term bonds and things like mortgages that are keyed off of longer term bonds. And this next chart I'm going to show you actually shows that the long-term bonds actually didn't rally. In other words, those long-term rates on longer-term bonds didn't come off. They actually rose a little bit. And that's following through today. So let me share a picture of that to show you what that looks like. The red curve here, this is the interest rate along the vertical axis for various maturity lengths along the horizontal axis. So right here is the reverse repo rate right out to 30 years. And what you saw here, so the red is on the 17th and the blue is on the 18th after the Fed decision. So you saw after the decision, we saw a drop in rates on the short end of the curve. But notice this, we saw a modest, a very small, but still a increase of rates on the long end of the curve. So that's really interesting. So it just in a picture speaks to the complicated set of factors that drive longer term rates. It's not the Fed's short-term rate decision. It's much more than that. It's worries about inflation. It's worries about federal budget deficits. It's worry about what central banks across the world are doing for reserves. And many of them have been buying gold instead of traditional treasuries and things like that. And I thought it would be interesting to kind of compare this to the last major crisis, the housing bubble of 07 to 09. And this is what the chart looked like there. So this is, and incidentally, yesterday, the 18th of September 2024, was the same exact day that the Fed started cutting rates in 2007, September 18th of 2007, right before the housing bust started to unfold. In fact, I think it was 1 month to the day that the market peaked in 07. I think it was October 7th, 2007. So not even a month. What I'm showing here is the interest rate that was in existence right before the housing bust took place and what happened, a year later. And what you see here is the Fed did drop interest rates dramatically in response to the housing bust and all the banks going in, belly up and the major crisis that unfolded. Yet the long-term rates barely budged. They were down just a tiny bit. Whether or not that holds as an example of what might happen this time around, I think it's interesting. I think obviously since this time we've had the Fed unleash things like quantitative easing that directly can affect the longer end of the curve. And I have no doubt that they'll at some point return to those kinds of policies. But I think it would have to be a very, very dramatic scenario for them to do that. And what I think is it probably would be accompanied with a major slowdown in the economy, and probably even more importantly for investors and our clients, a major sell-off in the stock market. Really interesting times. We're not going to try to predict, but we're going to watch our signals and kind of gauge what the market is telling us in these things. But the Fed has a tremendous balancing act ahead of it, we think, in the months and perhaps years to come. So we'll be very attentive to that. We still remain at valuation levels in the market that are near record highs. They're far higher today, for example, broadly in the S&P 500 than they were at the peak right before the housing bust, which was followed by an over 60% peak to trough decline in the S&P from the fall of 07 to the spring of 09. Not going to be an exact analog for what may happen this time, but all to say is we're still very richly valued at a very uncertain time with monetary policy and economic policy. I want to bring it back to our clients because this decision by the Fed to drop interest rates, understandably, is starting to conjure up some memories of much of the decade that followed the great financial crisis, where the Fed drove interest rates literally down to zero. So savers couldn't get any money on their savings and this and that. So it's understandable that many folks are starting to wonder, could that happen again? Could these attractive yields we've been getting in short-term treasuries and things like that, money market accounts, could they go away and we're back starved for income, starved for yield? I'm going to save my prediction on that. I do think it would have to be a major economic collapse and intervention by the Fed for that to happen. This really brings up the broader concept of investing for income. We get questions about this all the time. Obviously, most of our clients save their assets to provide for an income during retirement, to create a paycheck, so to speak, after they retire. So it's only natural that folks would be interested and curious about investing for income, whether it's things like bonds that provide regular income through coupon interest payments, or stocks that pay dividends, or other income vehicles. This is a very timely topic, especially because of the Fed just starting to cut rates. And just want to use this as an announcement that next week we're going to air the first part in a multi-part series. It's probably going to be 3 different parts of the series on investing for income. Next week's installment will be focusing on bonds as one tool for investing for income. We'll go over the basics of bonds, what they are, how they're structured, how they're priced, but also how strategies for thinking about using them to provide for income, including things like bond ladders. At a later episode, probably will be in a few weeks, we'll talk about things like stock dividends and investing for dividend yields in stocks and whatnot. And we'll probably follow that up with a kind of an anything goes segment that will capture other non-traditional ways, whether it's selling call options on stocks or using annuities to do like a pension replacement strategy. A lot of different ways to think about investing for income. But please watch out for those installments of that mini series coming up in the weeks ahead. That's all I want to cover here today. We welcome you to subscribe to our channel. Please post comments or feedback and suggestions for future content you'd like us to have. And of course, we welcome our clients and folks that are watching us. We welcome your questions and calls anytime. And until then, I want to wish you a great day and thank you very much for watching.